Hello everyone, welcome to Smart Investing. Today this video is going to be about the banking sector. So I have 5 stocks for you. We're just going to jump right into it. First stock up that I have, HFWA. We're going to start from the bottom all the way to the top. I'm going to look at some fundamentals and some technicals and also actually quants, and see if these stocks are actually good to add to a portfolio. So we're going to see and go over this together and see what's what. And we're going to continue on to the first page coming up. So this is my first page. And we're going to see and evaluate this. So $28.69. HFWA. So volume is at 138. That's pretty low, but we're comparing that to the average volume for the 3 months. So that is below the 188K. So PE ratio is at 13. So with that, show me as slightly undervalued. 52-week high and 52-week low of $20. High of 29. Market cap is at 1 billion. Earnings per share 2.2. Dividend is at 0.84. So the difference of 52-week high and low, I'm not liking it too much. Volume needs to increase and be more than the average volume. And that would gain some interest as to people liking it. Not only retail, but institutions as well. So right now, doesn't look like a good stock. So we're looking at the 5-year chart here. I'm using the exponential moving average 50 moving, the EMA 100, and the EMA 200. So we have here, it looks like it's pretty flat. We come up here to about 25.50. And that's pretty much what it stood, around 25.50. If you bought in 2020, yes, you gained a little bit, but so many stocks gone down in 2020 for the first 2 months, and then obviously a rebound in 2020, and that was the best time, one of the best times to buy stocks. But now we're trying to evaluate and see if it is a good stock. It is holding up, but again, it would have to break this high of about 29 bucks back in 2021 in March. So once it breaks that high, we would have to see if it holds up to that level and doesn't sell down. And then once it can keep up that level, who knows? Maybe the volume might increase and more people might be interested in this stock. So moving on to the analysis for the quants. Highest rating that it is getting is a 6.79. So close to a 6.8. So that is ranking it for the strategy for momentum. So that is telling me it's good for short-term trading. That is the best bet for right now. So if you were to do that, then let's see. We're looking at a difference of, let me see here. So we're looking at the difference in the 50 EMA and the EMA for 200. That's only like a $2 difference. And again, the price right now is $28.69. So if you round down, that'll be 28. Then let's look at the 5 years. So highest point from there was about 29. So it would actually have to break close to 30 to be for certain. So then it would have broken the high of 2021, and then next level would be around this level here from the 2018 levels. It's holding up, but again, for a long-term investment, this is not a good stock. For dividends and income, again, it's not a good stock. Like I said, it's looking good for momentum, a short-term trade, which would be like, a year or less. So again, you're only looking at about a $2 difference. So again, it would have to be about $30. That would be my guesstimate. Getting around 28. 28 would be okay. 29 would be nice to get a gainer. Going for 30 would be a little bit too greedy. But jumping at 28, getting on at 29, that would be fair to say. Get the dollar gain and get out. I mean, even if you want to be a little bit greedy, what, a dollar extra? It's just not worth it. If you want to chase the extra dollar. So, anyways, moving on to the fundamentals a little bit more. We're gonna look at some key indicators. ROA, return on assets. I'm gonna look at the yearly, and it's not showing too much of that. It might be lag or frozen on the app, so it's not showing me any of that. So I guess it's pretty slow. So anyways, we're gonna move on to the income statement. Annual statement we have here, 98 million for 2021. Total revenue, it's not showing me anything. But out of these three, the net income is the most important. So I'm going to look at the quarterly real quick. As you can see, Q1 and Q2 is only giving me about 19.76, rounding off to 20, and 18.5. So that is about 38 million. So if we add the 38 million, let me see here. So if we add the 38 million, we're going to see the estimates for the annual. So if you were to double that, and let's say, well, depending on the estimate, so getting an estimate that the actual estimates, I mean, they're slightly going flat, and they had a dip in Q2. So I would expect a little dip. I don't know, they might meet expectations. We'll see. They dipped a little bit, but not by that much. But again, they have beaten their estimates, though. The last 4 estimates. So Q3 is a higher estimate, and we're going to see if they're going to beat that one. So we have here $98 million for 2021. Anyhow, moving on to the balance sheet, 88%. That's slightly lower than most banking stocks. It's still bad, but better than most. Cash flow is positive, and it's pretty strong. So it looks like they have a lot of cash. They're definitely cash flow positive. Under $1 billion. And then we're going to see some peer comparisons here. So they rank about in the middle. So out of 527, they rank slightly above half for the earnings. And then for net margins, they rank number... Well, they're probably tied for rank number 9, I'm sure. I'm sure there's so many. Yeah, you see? All these ranks here for number 9. Yeah, it's not showing me too much. But as you can see, their debt, they're ranking in their lower half. So if you to divide that in 2, for the majority, they're doing better than their counterparts than other banking stocks. So again, to add this stock, for a long-term play, no. And for a short-term watch list, yes. But overall, I'm going to say no to this stock, no to a watch list, and we're going to move on to the next one. So next stock up, PFS. It is Provident Financial. That is coming in at $19.66. Volume is at pretty much half a mil. It is beating their average volume, so it looks like it's gaining some momentum. And then we have the market cap at 1.48. Difference of 52-week high, the spread of that. So $7 difference. You know, subtract the high from the low, $7 difference. What I've seen, a good difference is about $10. This doesn't meet that requirement, so right away, I don't like the 52-week high or lows. I don't like their spreads. So now we're going to look at their earnings. 2.08. Definitely they could cover the dividend. A yield of 4.88. Some people chase yields and then some people chase total dividends. But to each their own. But I'm showing you guys that anyways. So 5-year chart looks pretty flat to me. I mean, you can honestly see, you know, obviously in 2020 it's gone down. Then start to kind of break a little bit. And then now you had a really big flush back here in late September. So as we can see here, that really solidified it. And then it doesn't seem like, if you, without looking at the price, it does look like a big dip. But then if you actually look at it by price, it's only like a $4 drop. So we went from $23. Well, I was wrong, a $2 dip. So $23 to like $20. So that's like a $3 move. So that actually, you know, labeled it and confirmed it that, you know, that's a lower trend. So we're going to see what is the best strategy or the best use for this stock. So long term, which is what I usually recommend for a watch list. So far, I'm not seeing it. Not even for the short term as well. Looking at the financials, look at these estimates. They have to be estimates of about 60 cents. If that's what I'm seeing correctly. Sorry, I went too high there. But around 60 cents for the Q3 estimates. Then we have more indicators for the fundamentals. We have the return on assets. So Q2 and Q3, we're going to do it like that. So comparing to Q1 and Q2 in 2021, so it is about the same. So we have here, that's about the same. Oh, sorry, 29 and 34, that is about the same. And then this was actually lower in Q1. So in 2022, it slightly went lower than last year's. So they are going to, I would expect it to, you know, report earnings that are a little bit lower, as well as many stocks as well. So it looks pretty flat quarterly. Then we're looking at their earnings. The earnings look pretty flat as well. Net margins, it's not showing me. Their debt is at 88%. Pretty typical for a bank. Now we're going to look at the net income. These are just different measures to evaluate a stock as to their price. What is a good value? Basically, what's a good buying opportunity? What price? This is what this entails. But I don't really use those too much. I'm still learning how to use that. Cash reserve is similar to the cash flow, but they just holding onto it more. With cash flow, it's like they're putting their money to work more. This one's a little bit more passive, and cash flow is a little bit more active. So with book value, and then they also have price book. Those are new key indicators that I haven't learned yet. I still need to work on that. But I just use the basic PE, price to earnings. And then I just go to it from there. So we have here net income comparing to Q2 of last year. We had 44 million. They're down 4 million comparing to this quarter. So that is a definite decrease. And then we're going to look at the quarter before. Let me see if I can expand. So that would be the Q1 of 2021. Look at these bar charts, and this is definitely lower for 2022. And then I guess it's going to continue, I would assume so, for Q3 and Q4. Balance sheet is, let's see, it's going up for debt slightly, and then the assets are going up. But, you know, banks, they always like to leverage stuff. That is at 87%. Cash flow, at this point, I don't care if it's positive or negative. They do have a lot of cash flow. It looks like at about 150 million. So we're going to look at the quants real quick, see what strategy is good to use. I voted for the momentum because their volume is okay, but their price just needs some work. But overall, all in all, I just don't see it happening overall to add this stock to a watch list. Again, quality was the highest rating. That's what they rated it on Weibo, but I sort of disagree. I think the momentum was better. But overall, all in all, this stock, it just needs to do better on their 52-week highs. I think once they start breaking their numbers, which I don't see happening because they had a really big dip, I don't see it happening. So for this stock, I'm going to say no as well. No to a watch list. And we're going to move on to the next one. Next one up is FSBW. That one is at $27.01. Volume is really, really low. 52-week high and low. That is a difference of $10. Not too bad. Market cap is at 208 million. Is very undervalued. That's what it's showing me. Forward earnings, it's slightly above what it is now. So $27 and change. Not much of a difference. That's what it's showing me. Dividend is at 80 cents. Earnings per share is at 3.62. Better than, you know, the majority of banking companies. So we look at the chart. It's doing okay. Could be better. I don't see an uptrend here. Even for the year. Obviously, see it's a downtrend. It looked flat up until here. And then ever since February, just going down like a roller coaster. Gone up and then went down again. So it looks like they're going to reach new lower lows. If I had to choose between fundamentals and technicals, I would lean overall right now towards the technicals just because we're more in that kind of environment. So for the quant ratings, highest rating that they had was the value. So it's telling me that it is a good price to get this stock, but I'm not sure if it's for long-term or short-term. So now we're going to see quality versus growth. And then we have quality is better than the growth. That's what they're rating it. So we're going to jump in a little bit more. So $208 million company. I don't really see that happening as quality. Again, I guess it's a good value for the stock because it's really underpriced. But again, overall, I just don't see it. I just don't see it. It has to break. Like I said, it has to break new highs, and it's already gone down in a downtrend. So again, I don't see that happening for this year, and we're close to the end of the year. The volume needs to pick up a lot for it to gain on the technicals. It needs to break new highs again for the technicals, and then also, you know, it needs to hold up on the chart. It needs to hold up, at least for a good month for a stable price. So again, I'm going to say no to this stock. But we will continue looking at it real quick. So for return on assets, we have here lower than before for last year. So only down 0.10%. Still, a decrease is a decrease. Return on equity, we're going to look on that. It's not showing me. Maybe it's a little slow. It's not showing me. We're going to move on to the next one, net income. And it's part of the income statement. So, income statement. So, obviously in Q1 and 2 for 2022, these numbers are lower. And you see these bars are actually higher. We're going to extend this bar right here, going that way to see the Q1. And you can see in Q1, obviously, really big bar there. That is, I wouldn't say half of that bar, but really, really downgrading their numbers pretty much. I love this app because it just shows the obvious. So definitely lower net income, which, doesn't have the stock appeal to it. Doesn't look like, popular stock either. So at this point, again, I'm going to continue saying no. Even if the cash flow is positive, which it is, it still has a lot of work to do. So I'm going to say no to this stock as a watch list. So we're going to move on to the next one. Next one up, Capital One Financial. I've heard of this stock before. Volume is pretty high. 52-week high and low, 174 and 90. That is more than a $10 difference. So that's like a $80 difference. That definitely outpaces the $10 range. Definitely beats that. So that's definitely a good highlight. Another good highlight, it's not a small company, but it's also not rather large. So, $35.88 billion company. Volume is pretty high, close to 2 million. So if you're a technical trader, you know what I'm talking about. This is pretty active. I'm not even talking about for the week. I mean, on a daily basis. From years and years and years seeing this stock, it's a pretty active stock. So that is why you have 52-week highs and lows. You have those spreads because, this company has been around for a long time. I'm assuming they do good as a company and their business model is pretty good. Look at these earnings. That's one of the reasons. That's another big highlight. So this is a definitely big highlight. Earnings are definitely there at 22. Definitely high. The funny thing about this company, they're not really a bank per se, because their main focus is on lending. And I know a lot of banks do that, but they specialize in just a very small part in lending. We're going to read about that in a bit. But again, Capital One Financial, I've heard of this stock. Dividend is at 2.4. That is a pretty high return overall. Dividend, I know the dividend yield is pretty low, but if I had to choose between this one and this one, dividend returns are way better than the yields. And then we can look at the earnings and the price to earnings. Very, very, very undervalued and definitely really, really low price. But we're going to look at some technicals here. So it's reaching its 2020 lows. Well, not its 2020 lows, but its 2020 highs as of right now. So definitely a very, very undervalued stock. I like it overall for just income, the quality, the momentum. I see everything good a bunch of good highlights. I don't see barely any negative things to say based on the numbers and what I'm seeing. We're going to move on to the analysis. Well, we could keep looking at the chart real quick and then see this on a shorter term. Yes, it's going down, but the thing is that you don't really see this kind of total return. You know, if you see my previous videos or even through experience, you would know that a lot of companies, or even most companies, not even the banking sector in general, you know, if I was to say for the banking sector or in general, some companies don't even pay more than $1 dividend. Now, if we were to talk about a good company with rising dividends, uh, most companies, for the majority, most don't even pay $2. Now, when you start going above $2, then you know that's definitely a company to look at when it comes to an income portfolio. When you want income, well, when it comes to that, also you also want to get a good price on it, but then you also want to get some gains as well. So you can obviously see the gains from the 52-week highs, and then obviously we're in a downtrend, so it's going lower. Uh, right off the bat, I'm gonna say yes to this company. Um, Again, I can't give price points. I can't give numbers as to how many shares you should buy or whatever. Again, I can't make any of those recommendations because again, I'm not licensed or insured as an advisor. But the only thing I can recommend to you is to add or say to deny to a watch list. So again, that is my value bringing to you as a subscriber. So again, I can't call the low. I wish I could. Even if I did, I can't really say either way because again, I'm not licensed or insured. So looking at the shorter term, 52-week low so far was around 90. So we're gonna still continue to see reports on earnings. So I'd wait for it to go a little bit lower as well. I'm gonna look at the analysis for the quants. I would assume these are some high ratings. The growth, I can agree with that. The value is definitely there. I would agree with that. Quality, I would rate it a little bit higher. I'm surprised Webull rated it. Well, not Webull per se, but their third party that they use for the quants. Can't believe they rated it 6.7. I would have rated it more towards an 8. So again, they're not an actual bank. They're more a consumer lender. And their momentum is at around 7. I guess I could say that's fair. Income at 4.4. I would disagree with that. I think it's a little bit higher than that. But again, overall, they rated it a 4-star rating out of a 5. If I was to be more accurate, I rated slightly more than a 4. That's just my take on it. So these earnings is still pretty high, and they're still close to their estimates. Even if they do fail for Q3, they've beaten the Q1 and the Q4 estimates in the Q3. So out of the last 4, they've beaten 3 out of 4 last estimates. And then key indicators. We have here, yes, return on assets are getting lower. Let's see if it shows me return on equity. It's not showing me. It's probably frozen or lagged or something. I'm going to move on to the net income. That is dropping even lower. So annual income statement for 2021 was close to 12.4. That's pretty high. And then we have here total revenue. If it shows me, it's not. Pretty high on their debt at 85%, but that's how banks and consumer lenders operate. We're going to see if they're cash flow positive. So 12.31 billion on their operating. So they would have to be, let's see, so 16. So about 20. So they would need about 20 billion. They would need about 20 billion for their cash flow. Their cash flow negative. So even if they had in the net income, so they would be down actually 8 billion in their negative cash flow, even if they had the money in their net income. So profile, you can see here. I'm surprised it says diversified. I know. Okay, so they do services to consumers, small businesses, commercial clients, and digital channels, branch locations, cafes, and other distribution channels. But yeah, they're definitely heavy into the credit cards. Definitely heavy into the credit cards. And this is where they get a lot of their business from domestic consumer, meaning the retail consumer, and then the small business lending. Because, people try to start up their businesses and a lot of banks might say no. And Capital One is one of the few consumer lenders that say yes. So we have here, see, it started at 1994. And if you want to read more, go to their website and you can see that. So again, like I said, they're more of a consumer lender. We're going to look at the dividend history. So as we can see here, in 2020, I want to look at 2020 because that was a bad year. And then obviously, you can really tell how a company performs when, they're in the down years instead of in the good years. See how they hold up. 2020, they did a decrease in the dividends. Understandable. So they did a 30-cent decrease, I guess to save money. Then in 2021, they went right back for their dividend. Started to pay the 40 cents again. So that was an increase for 30 cents. Now, in 2021 as well, we're going to highlight that special dividend. Not only did the increase in dividend go for the 60 cents, so that was a 20-cent increase. In between that, they had the special dividend of 60 cents. And again, 2 payments on that same day for 2021. So not only did you have a raise in 2021 if you had this stock, you had the special dividend to go with it. Now, in 2022, they continued to pay the 60 cents. Again, no raise thus far, but we're going to see next payment. Maybe they might give a raise, maybe not. So we'll see how this all plays out. So for the income, for the most part, it looks okay. Decent stock. So overall, I will say yes to this stock. I know it's a little pricey. Yes to a watch list. So I know it's a little pricey, but the stock seems worth it. So next up for the stock is FRBA. Last one we have to go over. FRBA First Bank at $14. Gonna look at the 5-year. Volume is really, really low. Even the average volume really, really low. Undervalued. I wouldn't say majorly undervalued, but undervalued. 52-week high and low. There's not much interest in this stock. Nobody really likes it. Even though the market cap is at 275, there's no love for these small micro cap companies. Earnings per share is positive at 1.7. Dividend is only at a measly 24 cents a year. Comparing to the last company that I did, that's what I'm saying. Total returns are much better than dividend yields. Even for this price, that is just still too low. I know some people like really cheap stocks, but believe me, they will come. Not only for the banking sector, but cheap stocks, but good stocks, they're out there. They just have to be evaluated. That's all it takes. It's a matter of finding, the right stock, not at the right time, unless you're a day trader and know how to do technicals like I do. But all in all, want to see if it's a good stock or not. That's pretty much it. So overall, it doesn't beat the $10 difference that I usually see. So 52-week high and low, I'm not liking it. Earnings per share is positive, so it's not. I mean, it's an okay sign. I'm glad they're positive, but it could be better. I mean, and then they have a measly 24 cents for the year. I don't like that. 5-year technicals, we're looking at the EMA. So we have here $12.30. I don't see much going on. Again, it's gone down in 2018. Obviously, in 2020, most companies went down, went straight up. It's beaten its prior highs from the 2018 mark, obviously from the 2020 as well, and beforehand. But, it's still pretty flat. It's barely beating its highs, though, again, from, like I said, from the 2018s and the 2019s. So we still want to see those pops, and we want to see them hold, but they just haven't been holding. This is a really nice jump. I like that, but again, it needs to hold up. So for the most part, it would have to be above $15. Just not for me to gain interest in it, but just for people to be excited about this stock. It needs to hold up better. So like I said, around $15, that would be the ballpark. So it has beaten that $15 mark, but it's only held up for just a few weeks, and then it's just gone right down again. So all in all, as we can see for the year, when the 200 is above the 50, that is considered a downtrend. So you see what I did there? So again, when the 200 is greater than that one, it's a downtrend. And you see the downtrend. So when the 50 is below the 200, is considered the uptrend. So we can see here, I'm going to show you what I mean. So we have here the light blue for the 50 and the dark blue for the 200. The 100, I mean, it's a good indicator. I just use it more for price, but these are the two those are the main focuses for support and resistance. So we can see here, you can see the 200 right here is above the 50. So that's considered a downtrend. Now, when we look here into that part, we're going to look at the 3 months. So we have here, it started to go above that. The 50 started to go above. Well, it looks different on a 3-month chart and a 1-year chart. So again, we're going to still look at the 1-year chart, but now we're going to expand it. So that way you guys can see what I'm talking about. So it stood flat here, and this is where it went up. Right? So I know I'm a little bit late coming in here, but if we look at this chart, looking in on the chart right here, you see how, and I'm talking about the lines. I mean, stay with me here. We're talking about the lines. So we're starting to see, hold on. So you see how close these lines are right here? You see how the 50 is starting to break away, not only from the 100, but from the 200? See, it's starting to get wide. You see how wide it's starting to get? So then we have here, it's starting to get even more wide. So if we look at around right here with these two lines, you see how they're getting wider and wider and wider? So we have here the dividend around 6 cents. But yeah, I mean, it doesn't matter when they paid, but we just want to still look at the chart. We have here, let's see. So we have around $15 all the way to about 16. So $1.50 or $1.80 and change or whatever. Not even a $2 move, but more than a $1 move. So if you see this chart starting to break away, and then it started to go down again. So we can see here, started to go up, and then right around here, that's when it's close to the 50. So it actually started to be flat again. So what I'm saying is, when it started getting wide at that first jump, I know it would have been high to buy here, but who knows? You could have done some swing trading and then pretty much cashed out for that difference of the $2 range, or less than that. Because if we see here, it's not even worth it. 25 cents. So now we see here, we're starting to see some contraction. You see how wide this is, and then now you see how narrow that is. Once this 50 goes below the 200, this right here confirms that downtrend. That already confirms that downtrend. And then we have the 200 line above it. So again, this line is starting to cross it, and it's starting to go below it. So there you have it. 1 year looks flat. 5 year looks awful. So I'm going to say no to this company. And that's pretty much it. Thank you guys for watching. I know it's a long video. I will make a shorter video. But again, if you want to fast forward this video or watch it to waste less time, watch it on your phone. I recommend the settings for 744 pixels. And then please watch this on a 1.5 speed setting. So that way you can hear it faster. So thank you guys for watching. I'll see you guys in the next one. And I'll keep you guys posted. Next video will be up in a few minutes. And I will summarize all these stocks. So basically no, and yes to a watch list, and no. Thank you guys for watching. I'll see you guys in the next one.